understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Welcome back to another episode of Tech Behind FinTech. Happy Friday. Really excited about today's show, and I learned something new from our guest, and hence the title of the show. Joining us today on the Tech Behind FinTech is Chris Aliotta from Quantalytix. Chris, how are you doing this Friday?
I'm doing great. How are you doing today?
I am doing wonderful. My morning was great. Good little couple of workout things going on, and I'm like, feel really, really good right now. Today's title of the show is Financial Intelligence Unleashed, ALCO Reports in the Spotlight. As many of you may not have known what ALCO Reports is, we're going to jump into it. I didn't know until doing the research for this show, and I'm really fascinated by it, and I want to ask a lot of questions from Chris. So before we go into Chris's bio, we're just going to talk about a couple of housekeeping things. We are streaming live from Facebook, LinkedIn, YouTube, Twitch, and we have a live stream going on from Instagram or from offline. That's so if you're on Instagram and you're watching us, if you want to be part of the show, which your questions will be posted on our screen, go to the techbehindfintech.com, click on one of the play buttons, you'll get a YouTube link there. For everyone else, please feel free to ask questions and so forth. We'll post your comments. Now, without further ado, let me introduce our wonderful guest, Chris, to our show. Christopher, also Chris Aliotta, is the founder and president and CEO of Quantalytix, a Birmingham, Alabama-based fintech startup specializing in advanced analytics and loan management systems. With more than 16 years of banking and fintech experience, Chris has mastered the interest rate risk management, credit risk management, leveraging and monetizing data, bank strategy, loan deposit valuation, balance sheet profitability, relationship profitability modeling, asset liability management, relationship profitability modeling, I said that, cloud software trends, and data tools. Chris, man, it's a very extensive resume. You're basically a banker.
I was at one point. Yeah, a banker and tech enthusiast, technologist, if you will. So kind of a perfect way to be on this stream, bridging the tech and how money works. So
I absolutely love that. Before we get into it, and before we get into the ALCO, how did that work out? I mean, you start purely on the business side. How did you start adding technology to the mixes? Obviously that's what we talk about in the show. So I'm just curious with that transition. How did that work out?
Yeah, no, I got to apologize earlier. I was trying to prop this laptop up so the camera would be more in alignment, so you're not looking up my nose. But it fell right when the stream started. So unfortunately, so if I'm looking out into space, my camera's really right in my keyboard. So just people know.
It's all good. You're doing well.
So that's a great question. So the funny thing is, I actually didn't start as a banker. I think like most technologists, we find a passion in technology probably early on. I've heard people say that, technologists are born, they're not created. Sometimes, change that with programmer too. So from a young age, I was very fascinated with computers, writing software, writing code. I used to take the code from the back of Highlights magazines and write it in BASIC and DOS. So long story short is I really started off as being a software developer, believe it or not. I can program in something like 12 or 13 different languages. I've lost count because it's a passion of mine. But when I made a decision early on in my career when I was in college that software development was great. I loved it, but I wanted to use it as a tool. And I wanted to merge that passion with another industry or another focus. And at the time, finance was very interesting to me. I thought it was very fascinating. I thought I was going to be like a Wall Street day trader or whatever. And I was like, I'll use my programming experience to get into that and, really kick some butt and, whatever, be the next, Wolf of Wall Street, whatever story. in a positive way, not in a scam way, but
Of course.
but little did I know, boy from Buffalo, New York, it's not a big money center, so that dream never really happened. But what was fascinating is I got into commercial banking. I got lucky enough to be brought into what was called a management development program out of one of the commercial banks, and it was a pretty decent sized commercial bank. And I got pulled into an area called corporate treasury, which to people who don't know what that is, you can think of it as almost like the nervous system for the bank. We touch and see everything, and we're responsible for the management of everything within that bank, from the loans that we have to the investments that we make, to the deposits that we bring in, to the leverage that we create, even to the equity that we raise. It is the most strategic part of the bank because you get to see everything. But what's cool for me is, I'm not like a sales operational guy. So for me, it was like, oh, I get to see the final result of everything, and I don't have to do any of the work in terms of bringing this stuff in. So it was exciting because at a high level, you get to see how the bank works. But more importantly for me, what was really fascinating was that there's a connectivity to the secondary markets. So like your Wall Street side of things. So I got the best of both worlds. I got to see traditional banking, how it intersects with the markets, the financial markets, as most of people would think of, Wall Street, whatever. But then I got to really use my technology skills to the betterment. In other words, what we do in Treasury also requires risk management and modeling, financial modeling, and that's where you get into some of the really cool esoteric type, quantitative engineering and math and things that I quickly fell in love with, the predictive sciences and things like that. So, before AI was the rage, we were, it wasn't called machine learning at that point. They were just called statistical regression models. And we had all these things well before, they were, sort of thrust into the limelight. But it was exciting, and it is an exciting place to work in. So being able to bring those two worlds together has helped, kind of create my background, but also was the genesis for my company.
Oh, fascinating. So you mentioned when we were offline that when you were at the bank in Buffalo, how you got into ALCO reports.
Yeah. Okay. So let's take a step back here and talk about what ALCO reports are, because it's if I were listening, I'd be like, ALCO reports, who cares? What does that even mean? So ALCO it stands for Asset Liability Committee. And so really what it is, it's a report for a committee, but what they are is it's really a deck, or it's information. It's quantitative information around the bank's position. So what does that mean? So recently we've been hearing a lot about interest rates going up. Well, interest rate movements has a big impact on both commercial and community banks, as well as every bank, to be honest with you. But it also has an impact on Main Street as well. And we can get into that later. But the purpose of the ALCO reports is to shed light on what could happen if interest rates move. How does that affect the balance sheet? How does that affect our ability to make earnings? What could potentially happen? And in some cases, if you abstract that to sort of the modern view of ALCO, which is more balance sheet management, which includes a credit perspective and liquidity perspective, more of a liquidity perspective, I should say. It really paints a holistic picture of what could go wrong or what could happen with your organization. So it is one of these things that not a lot of people are going to know about. It's purely your senior level, your C-level, your executive vice presidents. They will have access to it. It's more guidance than it is. How can I put it? I don't want to say it's more guidance. It is guidance. It's a little bit like, I'm trying to come up with a great analogy here to describe what these reports are. It's kind of like a what-if analysis, like a choose-your-own-ending type report, which is, if you do this, this is what's going to happen, or if you do that, this is what could happen. So, and we can break that down a little bit more later on.
Is fintech and more cybersecurity, merging the two. We have something called like a risk register. So we start looking at a company and all the different risk that can go wrong regarding cybersecurity in general, right? And then we say, okay, what are we going to do with this risk? Are we going to mitigate it? Are we going to basically outsource it? Or are we going to ignore it, right? And hearing you describe ALCO reports, obviously you're dealing on the business side. You're dealing, okay, what happened from 2020 to now, right? Interest rates were, oh my goodness, I want to go back to those interest rates. And all of a sudden, those interest rates jumped up. So now, if you're in 2020 and you're on this Asset Liability Committee, is that something that you're foreseeing potentially? Like if interest rates, I don't know, what is it, quadruple, right? Where does that put the bank? Is that how it works? So that looks like an obvious risk.
Yeah, absolutely. So, and that's a great example. So like, okay, let's take the cybersecurity, like threat assessments or threat reports or whatever. What you're doing is you're presenting a surface of things that could go wrong, right? Or potential areas where there are risks. These reports do similar things, but with market factors, right? They'll say, hey, what happens if interest rates go up? What happens if credit losses increase or decrease? What happens if our deposits run off? There's so many different ways to kind of slice and dice these reports, but the primary purpose of an ALCO report, and I do want to abstract that to a larger where things are going now. ALCO's traditionally has been hyper-focused on interest rates and liquidity, but in today's world, it's now starting to include credit and other, how can I put it, in capital, and other the more holistic way of running and managing a bank. So what are the traditional things that come out of an ALCO report are interest rate simulations. So what happens if interest rates move? We would call those like our NII type simulations, net interest income. So it says, hey, if interest rates go up, how much more money does the bank make? If interest rates go down, vice versa. And it's not always, there's not always an inverse correlation there. Sometimes they can make money when rates go down versus when they go up. So there's all different ways that these reports can show you things. But then the other one is what we would call our economic value of equity, which is more of a longer term view of, okay, well, yeah, in the short term, you may make more money, but in the longer term, the value of your organization is going to decrease in value. The share price or the economic value of the organization will decrease if interest rates change. If you were to sell the entity, you could expect to get less or you could expect to get more. So it's a little bit like if you had a bond portfolio. That's exactly what we're doing with these ALCO reports. We're showing what happens to the value of those bonds in the event that interest rates go up or down. We're showing the value, or we're showing what the predicted cash flows are going to be when interest rates change. So it's very much, it is a science of fixed income. It's fixed income analysis at the heart of it. I may have gotten on a tangent there, so bring me back in if I've gone too far.
No, not at all. So, all right. So you mentioned a few things, and before I start, because I have questions around the committee itself and the members of those committees, but just taking a step back in terms of what we're talking about. So you mentioned that traditionally it was about interest rates.
Yes.
Now we're looking at balance sheets, liquidity. So it seems like, based on what we're talking about, it's adapting based on what's going on in the environment. Obviously, about the regional banks and the SVB and the different banks that just shut down or had to be saved by the government. With the ALCO reports changing, was it because of these market conditions and things happening in the industry?
So the short answer is yes. And let me give you a bit of a history here. So back in the 1980s, Paul Volcker, he was the head of the Fed. I think what they ended up doing was decoupling the dollar from gold and allowing interest rates to move. Again, my history is kind of fuzzy there. But what happened in the 80s is, as a result of interest rates moving, we had the SNL, the savings and loan crisis, where all these banks essentially became insolvent due to their inability to basically cover their cost of funds. So what does that mean? So like in banking, we will make you a loan, right? But at the same time, we will, to fund that loan, we will take consumer deposits and we will pay them a portion of the interest we charge. The thing is with consumer deposits is that interest rate can vary. It can move depending on market conditions, right? So in other words, if I can go and put my deposits in a bank that's going to give me 5% versus the one I'm at right now that's giving me 1%, I'm going to move my money, right? So in order to retain those deposits, banks have to have what we call like an elasticity in terms of that deposit pricing. So anyway, long story short is those deposits are tied to short-term rates, which I'm not going to get into the yield curve, but bottom line is when the cost of funding exceeds the cost of money that you're bringing in. So let's say that loan I made is at 5% and now I've got to pay out 6%. I'm losing 1% in carry. So the reason I bring that example up is because every crisis that we've had from the 1980s and further on, I mean, banking is one of the oldest professions in the world, has created another layer of risk management that has been added onto the stack. So let's fast forward to when I started my career, which was in 2006, actually 2005. I came in right at the beginning, right before the financial crisis. So I got this, roller coaster view of everything that happened, this masterclass. And that was a big failure in credit. I think, largely it was credit. That whole debacle, there's so many different moving pieces to it that we could spend an entire podcast talking about it. But the long story short was that was mostly credit and liquidity driven. This new crisis that we're going to find ourselves in, if the yield curve is going to be predictive like it has been 9 out of 10 times, I believe is going to be one around liquidity. I think it's going to be one around there not being enough deposits or there not being enough easy money or cheap money for these banks to, adequately, what's the word I'm looking for, be viable. So again, those are, with every new, where I'm going with that was with every new catastrophe, there's always going to be another layer of regulation, another layer of risk reporting, another dynamic that we're going to have to incorporate.
So a question I have, right? Just going back now, because I'm going to really break this down and get into this ALCO. The Asset Liability Committee, is that something mandatory that every bank, no matter size, has to have in their organization?
Yeah, so the OCC and, oh goodness, what's the other body, have basically stipulated there is a set of rules that all banks have to follow. And there are best practices that all banks have to follow. And one of which is having a loan committee and an asset liability committee, and also a credit committee, so on and so forth. So there are different risk pillars in lending, and each one of those has its own regulations and rules around it. So every bank that you talk to, community bank, credit union, they are going to have an ALCO committee. They may not call it an ALCO committee. They might call it a enterprise risk management, or they may call it something different. But it all, at the end of the day, it is either a direct link to ALCO or a just a different renaming of the same thing. So.
Is the ALCO, is that audited by an external party? Like, would someone come into a bank and basically audit and say, okay, let me see whether it's an enterprise risk committee or an ALCO, let me see your past 2-year reports that you generated, who's on the committee, what's their background? Is that something that's being audited?
Oh yeah. So, this is funny. Most people do not realize how heavily regulated banking is. It is incredibly regulated. So when you hear people saying, hey, we need to regulate the banks more, well, take that with a grain of salt. We've got to be careful what we're asking for here. Banks are very regulated organizations. You cannot do anything at a bank without the blessing of one or two federal agencies or state agencies, state banking authority or the FDIC or the OCC. Any number of regulators can come in and stop you from doing what it is you want to do. So where banks get in trouble the most is when they try to be cute, when they try to do things that fall outside of their charter or their scope or traditional banking, or where they throw risk awareness to the wind. They don't pay attention to things that are very well known and decide to engage in risky behaviors. And you'd mentioned Silicon Valley Bank. That is an excellent example of where ALCO not failed. ALCO did its job, but where senior management decided to not act on what ALCO was showing. And the regulators ignored it as well, which is even more damning because the regulators, what happened with Silicon Valley Bank should have never happened, period. And I actually I had something here, and if you'd want me to share it, I'd love to show you guys this. It's in their 10Q, which is their financial report. And it's actually literally a page from an ALCO report, and I can show you how to read it and what it means. But they have been disclosing since 2020.
That would be awesome.
Yeah, they've been disclosing since 2020 their interest rate risk position. Nobody paid attention to it. So let me do this real quick. I'm going to present, if that's all right with you.
Of course, let's do it.
Share screen here. Okay, I've got 2 monitors here, or 3.
Totally dynamic. I love it. Let's do it.
Let's pull this guy up. All right. So can you guys see this? This is a.
Wait, hold on. I got to add it to the stream. Boom. Okay. It done. Let me maximize my screen so I can see a little bit clearer.
Yeah, I want to zoom in a little bit here. I got a 4K monitor, so
okay, I can
may
see
not
it
look
now.
good for everyone else.
Well, this is great. I love. You know what? This is totally dynamic. Wasn't planned. I love the fact you presented. We're going to go through a real statement because now this is going to lead me to a whole slew of questions. Awesome. Let's do it.
Yeah. So this is out of what's called a 10K, and sometimes they're in the 10Q. Those are the annual reports and the quarterly reports that get filed with the SEC. All the investors look at this stuff. This is the stuff you go to jail for if you misrepresent. Okay, so it's a pretty big deal when these numbers get published. Not every bank actually publishes their EVE sensitivities, believe it or not. I was trying to find some for some of the banks I work for, and it appears that they've removed them all from their 10Qs and 10Ks. But SVB did not. And I love that about SVB because if I were the CEO of SVB, and again, I forget the gentleman's name, I would be pointing to these reports saying, we've been showing this. This is not something that we've hidden. You guys should have known about it. The regulators didn't do anything about it. And that's not entirely true. From what I understand is that there was some MRIAs, matters requiring immediate attention, which are pretty big deals. Those are like, come see the principal, and if you don't take care of this, you're in big trouble type actions that the last regulators or auditors had with them. But I digress. That's a whole different topic for another day. But what we're looking at here is what a typical, very, very, very distilled ALCO report would look like. And we've got here what's called our EVE, estimated EVE, which stands for economic value of equity, and then estimated NII. And then what we have off in the vertical column here are...
NII, what does that stand for again?
What's that?
What does NII stand for?
Net interest income.
Okay, great.
Yep. So net interest income is what we received in interest versus what we paid out in interest expense. So what we got from our loans and what we paid to our depositors, you net that out, and that's your net interest income. So fundamentals of banking, that's really how we make our money. It's just that carry between those two. So on the Y column here, or where you see plus 200, plus 100, so on and so forth, that's what happens if interest rates move up in parallel 200 basis points, which is 2%. So whenever you hear someone talking basis points, 1 basis point is 0.0. I hope I'm getting nervous. Yeah, 0.01%. Okay, so if I say 100 basis points, I mean 1%. So this is what's fascinating here. So this baseline dash here means, okay, under current market conditions with nothing moving, the economic value of equity, which again is more of a relative measure than it is something that I would really put, a lot of, how can I put it? I wouldn't overanalyze it. Let me put it that way.
So before you move on, just so we're clear on what we're looking at, if we start with December, you want to go to 2021 or 2020? Which one do you want to start with?
I'm sorry. So let's start with 2021, and I'll work my way back down to 2020. Okay.
So looking at it, right, that means the bottom is if interest rates go down -100, -200, if it goes down 1% versus 2%, or if it goes up 1%, 2%. That's what we're looking at right now?
That's 100% correct. Yep.
Okay, cool.
And those are
I'm going to be asking you questions in between. I want to make sure that we're moving forward the same way.
Yeah. And those are traditional measures. I mean, again, there's an art and science to this type of analysis. And, for the people that are watching this stream, I'm going to try and keep it really simple. You can tell that I geek out on this stuff. So, again, I'll try my best to keep it simple, and I'll try my best to relate it to relatable things. But when you hear that the Fed has raised interest rates, typically this is what we're measuring against. We're saying, okay, Fed has raised interest rates. Now, if there's someone who really knows what I'm talking about, they're going to argue with me on that particular statement. But let's just assume that for the simplicity's sake, this is what we mean. This is why banks pay attention to it. So, okay, under normal circumstances, they're saying that their economic value of equity, which is the value of that organization right now, is $20 billion, $20.6 billion. Okay. Now that doesn't include what present value of growth opportunities, which means any new business that they might do. When we do this analysis, typically what we do is we do it in what's called a modified liquidation point of view, which assumes that the business is solvent, but we're not going to do any new business from today onward. And this is what we would hypothetically sell the organization for. So it's actually a really cool measure if you think about it that way. So it gives you sort of what would be the, what would be the net present value, more or less, of what those income streams would look like. So bottom line is, at a minimum, you would sell this bank for no less than, $20.6 billion. Okay. So where does that become? Why is this important? Well, if you look at the up 100, which is up 1%, so if interest rates go up 1%, you will see that the economic value of equity has actually decreased by $2.8 billion. Okay. So that's a 13% change in value of the company. Even more crazy is at the up 200, you're seeing almost a quarter of loss of value in the company itself. Now, mind you, if we go over to this column called estimated NII, what that is saying is, our annual estimated net interest income is $4.2 billion. And in up 200, we expect to make $5.2 billion. And you might be wondering, well, hey, why is it that you're making more money? You're making more money in the up rate environment, but the value of your organization has actually gone down. Well, you got to remember that this NII view is a 12-month view. It does not look out into the future, and it does not take into account changes in rates on what could happen much later on and much further down in terms of future payments. So it's a very short-term view versus EVE, which is a more long-term view. So the reason I bring this up, though, is that if you were to see that in an up 200, you're going to lose over a quarter of the value of your organization, that's a really big deal. Most banks are regulated, and we have what are called risk limits and tolerances. And again, it's been a while since I've had to review the documentation and the literature around that, but typically we try to minimize that variance, especially in EVE. We try to neutralize that. We try to have an interest rate neutral portfolio. These guys decided that they wanted to basically sacrifice the long-term value of the organization for short-term gains by way of overloading their investment security portfolio with bonds that were longer dated, which are more sensitive to interest rate changes. And as a result, they would pick up more interest income and be able to make more money. So why I'm showing this to you guys is that this was back in 2021. And if you look even back to 2022, they still had this sensitivity, but it wasn't nearly as bad. I mean, you can see that it was 15.4%. So between 2020 and 2021, they made an active decision to become more sensitive to rising interest rates and in a significant way. And that's why, to a certain extent, yes, they were greedy, they took more risk, but it's really, the mud isn't really on their face. The mud is on the regulator's face. This should have never happened. And it should never have gone from where it was in 2020. It should never have existed like this. 200 basis points is not that big of a move when you're at zero, and which is what we were joking about with interest rates being so low. That's just a normal move back to what we would consider more of a normal environment, normal, interest rate environment, or historically normal interest rate environment. So really what we should have had is plus 300s, plus 400s, plus 500s. As you guys are aware, interest rates went up, 400 basis points, 500 basis points. So we reached this 200 in more ways than you can imagine. So as you can imagine, the sensitivity only gets worse as you get higher up in terms of interest rate movements.
So for those on the podcast, for those who are going to listen to this podcast in the future, I'll do my best to describe what we're looking at. as we go through the conversation. But for right now, it looks like if interest rates remain flat from 2020 to 2021, they almost doubled their EVE, right? They went from like 11 to 20.6 billion, right? So, why did that happen? Or what were some of the factors that led into that?
Yeah, so and I'm just trying to track here. So 11 to 20. So this value is just, if we're looking at the base from 11 to 20, that means that they've added assets. It could be that the company has grown. So that's a good thing. You want your EVE to increase in a base scenario, right? You want it to go up. In general, you want your EVE value to always go up. But what you don't want to happen is from your base scenario for it to go down when interest rates move. You want it to be somewhat neutral. It's very hard to have a neutral balance sheet, but that's what we aim for.
What's interesting, right? If you look at 2020, if the fluctuations are not as bad, even if it went down by 2 basis points or up by 2 basis points, the difference from it being flat is about 1 billion and change of that. But the following year now, when interest rates go up, that you see that's closest 5.7. Yeah, it's like almost 6 billion, 5.7. It's drastic, but they would have made on their NII, right, 5.2 billion. So you think that's what they were shooting for? Or am I looking at it incorrectly? You think they were shooting, because that number is huge. Like they just made, if interest rates go up, they're looking like, we just made 5.2 billion.
Yeah, and there is something to be said about that. Again, I got to make sure I've got my numbers right here, because it does say dollars are in millions. So yeah, that's 5.2 billion, and that is a $5.7 million loss. Yeah, but again, remember that's short term, so that might be the first year. And again, it doesn't. How can I put it? That is actually a really good point here, and I don't know why I can't articulate what I'm thinking here. So bear with me as I kind of muddle through that. Yeah, I do think that is something that they probably looked at and said, yeah, you know what, this EVE measure really doesn't mean much, in the sense that we are going to pick up that 5.2 billion. We're not going to be selling the bank. So as a result, this really isn't something that concerns us. But the problem with that line of thought here, and again, this is the big issue here, is that they also weren't anticipating all their deposits to run out the door. And so what happened was, when their deposits ran out the door, well, they had to find ways to fund the balance sheet. And typically what banks will do is, when you have an excess of deposits, you'll go and buy securities with them. Highly liquid, easily tradable securities that can be sold on the secondary market and be able to get that cash back, right? Because you don't want just money sitting there not earning any interest. What happens though, and this is bond math, is when rates go up, prices go down, and vice versa. So when rates go up, rates go down, prices go up. Well, rates have been at a historically low. I mean, they've been at floors for a while. And again, just speaking generally here. So the issue here is that banks, what they weren't anticipating was rates to move as fast as they did. And when they did, those bonds that they bought for liquidity purposes, they actually had a loss on them. So here's the example I use. You lend me $100, I go and take that $100 and I go and buy stock with it, right? And then I collect the dividend on it, all right? Well, then you come back to me one day and you say, hey, I need my $100 back. Well, maybe the value of the stock is now, $98. Okay, well, now I've got to go sell that stock at a loss and then hope that $2 that I can go find it somewhere. And that's ultimately what was happening here with Silicon Valley Bank, is that you had what was a liquidity issue. They went and sold their securities at a loss, didn't have enough to, more or less fund the balance sheet. But in taking those losses, they also killed what was their capital. It basically ate their capital away and basically drove them into insolvency. So I'm trying not to get too technical into the weeds here, but there's a dynamic element to this where, yes, this is a good measure. Yes, it tells you a lot. but you got to think about it within the context of what could happen within some of these other market interdynamics that could occur.
You know that okay, I think someone has a comment. Let me post it on the screen. From Chad Hoshi. Love the commentary, Chris and Namdi. Having technical difficulty following this video feed, but I believe the content I've heard is very relevant. I had lunch with Will B a couple of weeks ago, and I'd love to catch up with you guys so we can discuss more constructively, create actionable steps to move forward. Interesting. Not quite sure.
Yeah, Will B is he's talking about Will Bryant. Will Bryant is one of my co-founders that started the company with me. So actually, I know Chad from way back when I was in banking.
Okay, here we go.
Good to see you.
I'm going to be honest with you. This is live, so sometimes I go with the flow, but I'm like, okay, I'm kind of confused here, but thanks for the save.
Yeah, no problem.
That's good stuff. Yeah, man. Can we? Thanks for that presentation and that breakdown. Very, very interesting stuff. And I think our audience really benefited from that. I know I did. It's my first time even looking at that. And so let me just jump back into this. Let's jump into the ALCO conversation. What you mentioned that is something that every bank. So in looking at a fintech startup like a neobank, very new out the gate, one of these, a couple of different questions I have. I want to go with that direction, and I want to go with technology platforms that are now banks, like WhatsApp or looking at Apple Pay. But let's look at a fintech like a neobank. Is that something you mentioned that everybody has to have that? And I know that the regulations sometimes may differ among these types of what is considered a bank. Would they have to have something like that without?
So the short answer here is the neobanks. Let's just talk about. I call them non-traditional banks. Okay, so these are organizations that may not have a banking charter, that may not have FDIC insurance. Typically, if they're falling outside of having a traditional banking charter or an FDIC type agreement or insurance, that's usually what I think of as a neobank. So they're not really banks. They don't fall. I don't want to say they're not really banks. They don't fall under the regulation that your traditional bank would fall under because they don't also receive the benefits of what those banks also receive. And it's not just the insurance, it's the access to wholesale funding. It's the access to emergency cash when you're, let's just say there's a run on deposits or you don't have enough to fund your balance sheet. You can go and borrow from the federal home loan banks, or you have access to what would be called, I guess the Fed, the New York, or not the New York Fed, it's the Federal Reserve, we'll just say, where you can get cash overnight to fund shortfalls on your balance sheet. So in being part of the traditional banking model, you get access to these facilities that as a neobank you won't have access to. And then not only that, but you won't have access to the leverage abilities that some of the banks have as well. On the flip side, though, you can take way more risk. You can leverage yourself way more than the other banks. Being not regulated, it has its benefits. You can be a lot more creative. But at the same time, too, if you're not careful, you will get yourself into trouble. And ultimately, what I think is going to end up happening at some point is you're going to find a neobank that grows phenomenally, and they're going to do something stupid that we've figured out in traditional banking. And then you're going to see a whole new level of regulation fall on these neobanks that, wasn't there before, because it only takes one bad actor to ruin it for everyone else. And that will happen.
Okay. Interesting. The next question I have for you, companies like Apple, if you look at Apple Pay, right? You deposit, get a ridiculous interest rate, that they're acting like a bank. Is an ALCO committee something that they would have, or because it's not regulated in that same
they wouldn't have. So since they're not regulated, and it's from what I understand, I don't know much about Apple's model here with Apple Pay, but if they're not FDIC insured or they don't have a bank charter, then they're likely not going to be regulated as a bank. Now, there may be other financial regulations that they fall under, especially if they're transacting business or acting as a money intermediary. Some of it they can't get around, which is BSA, AML, Bank Secrecy Act, anti-money laundering, which falls under KYC, know your customer. So that's where a lot of the crypto exchanges get in trouble, is they don't have good BSA, AML, KYC type procedures and policies. But you asked me, would they have one? It's possible, but unlikely. And should they have one? My answer is, if they are making loans and leveraging those called deposits or cash on balance sheet, then yeah, absolutely, they should have some form of risk management around that. Because again, depending on how they want to manage that portfolio, they got to be aware of the certain risk. And it's not only just the risk, it's what options they have in front of them. Different ways to monetize. There's different ways to make more money. There's also ways to do so that reduce your risk but increase your return, which sounds kind of counterintuitive, but you've got to look at things beyond just the cash flows. So,
you know what? I think this is a perfect segue into the services you provide for Quantalytix. Can you describe those services?
Yeah. Okay. So Quantalytix is again, it was the genesis of the company was back in banking. I quickly realized that, a lot of the information that the larger banks have and the abilities and the skills that they're able to hire from, a lot of organizations really either didn't know they needed it or knew they needed it. And so my goal was to be able to bring that big bank analytics down to the community and the mid-sized banks where that may be out of their reach. And not only that, but it was my desire to take the finance, the business unit knowledge that I had and merge it with the technology knowledge that I had, to be able to bring banks into more of a modern environment. And any fintech that's been working in the banking space knows that, banks are slow to adopt technology. They're even slower to, bring a new vendor in. So our whole approach here has been to help them see where that fits with their strategy, and then ultimately how to use all the fund finance stuff that we can do to help drive profitability, retain customers, protect their balance sheet, and so on and so forth. So as offline when we were talking earlier, what we were trying to do is take like a senior level type quant, and automate that in a way that allows your average user to be able to leverage that information and that expertise.
That's awesome. I know that pretty much wrapping up our time. Look, I consider you once that, like, certain guests, especially ones that I have these types of conversations with, and we can go on and on. I consider you a friend of the show. So definitely like to call upon you to come back, especially when like something happens in the industry or we want to just dive further into it, because it's so many. I have more questions around ALCO in the committee. The last question is, who are the members of the ALCO committee typically that you would see?
Yeah, so typically it depends on the size of the organization. So if you're talking a small community bank, it's going to be your CEO, CFO, your chief risk officer, all of those folks. As you get larger, maybe the CFO might be part of it, and generally speaking it is, or sometimes it's the treasurer who sits beneath the CFO. But typically in these ALCO meetings, what they try to do is they try to bring in the different business unit leaders, the different executives, so that they can see, the risks and exposures. And truthfully, I'll be honest with you, most of it generally probably flies over their head, which is why, and just more specifically here, is why with my company, what we were trying to do is we're trying to show them how to use that information. There's an educational component to what we do. And so that's, if I had to really distill it down, it was, how do you make use of this information? Because I guarantee most people look at it within these organizations and they understand it at a surface level, but they don't really get it from how it can impact their business. So that's where, Quantalytix comes into play. And that's where we take all this information and we help them with it. So.
Oh, awesome stuff. Listen, thank you very much. Let me just get a word from our sponsor. This show was sponsored by strategic generation, offering cybersecurity for sales and partner enablement, which includes SOC 2 reports, seamless due diligence, and application penetration testing. You can find them at strategicgeneration.com. So again, Chris, thank you very much. How can people find you?
Yeah, they can find us through our website, Quantalytix.com, and if they're bold, they can reach me through LinkedIn. I know that you did, but like I'm kind of bad at it sometimes. So, but generally speaking, I do get back to people. And again, through our website is probably the best way. But if you want to get access to me, just ask questions. I check LinkedIn fairly regularly, so that's probably the best way. So.
All right, cool. So this concludes our show for today. Guys, thank you for watching. Really, really appreciate the viewership. Appreciate all the behind the scene messages and the comments, chat. Thanks for the comment. Guys on Instagram. Oh, wait, we have before we take off, we have actually a question from Instagram. A friend of mine, Kevin, he's asking, what can an ALCO do with the estimated EVE information?
Yeah, I mean, thinking about it, one, it's just exposing what your longer term risks could materialize into, or that there are sensitivities on your balance sheet that you need to be paying attention to. In this particular case, the question they could ask is, well, why do we have such a variance there? And I actually believe that they do disclose within this 10K that most of it comes from their investment security portfolio. So if that's the case, which is used for managing the liquidity of the balance sheet, if that's the case, there are several things they could have done to neutralize that risk. They could have entered into interest rate swaps that would have, as an option, would have effectively neutralized that risk. Naturally, they would have made less money because there's a risk return trade-off there. But when they went to go and sell the securities, they would have received more than likely close to par for them, and they would not have fallen into the issues that they fell into. This was completely avoidable with what happened with Silicon Valley Bank.
Thank you for that, Kevin. Great question. Thanks. On that note, we conclude our show. You can catch us here every Friday live at 12 p.m. The Tech Behind FinTech is the website, and you can find us there. We are live every Friday, 12 p.m., streaming from Facebook, LinkedIn, YouTube, Twitch, and we have a separate stream going from Instagram. Those on Instagram, if you want to be part of the show, you can go to the Tech Behind FinTech website and view it there as well, and you'll see both Chris's, the guest, and myself, just not only me from behind the scene. And that's it. Chris, hang off in the studio. I want to talk to you, and that concludes our episode today. Thanks.
All right, thank you.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.